Hello everyone, I'm Sudha Udaya. Welcome to today's unit in the Building and Construction Programme. Before we begin, I want to remind you of the purpose of this programme. Each unit is designed to give you the knowledge, skills and industry behaviours required to become a competent and confident building practitioner in Australia. Throughout this course, I'll be drawing on more than 30 years of hands-on experience in residential and commercial construction. My goal is to connect the theory directly to real project situations, showing you how the National Construction Code, Victorian regulations, WHS requirements, and industry standards apply on actual work sites. As we move through each topic, think about how these principles translate into the decisions builders and site managers make every day. By the end of each unit, you should feel more prepared to apply these concepts in practical, safe, and compliant ways on the job. Let's get started. Today's session is Module 3, Volume 1, Section 3, Pay Contractors and Suppliers. In this session, we will walk through the complete cycle of money flowing out of the business to contractors and suppliers, and money flowing into the business from clients. We will link this directly to the financial health of a construction business in the Australian context. By the end of this session, you should understand how to review invoices from contractors and suppliers, authorise and make payments correctly with proof of payment, manage progress claims and revenue, and chase outstanding debts. Monitor the ongoing financial health of the business using sales calculations and financial ratios. Maintain accurate financial records that meet Australian tax and record-keeping requirements. Why payment systems matter. In construction, cash flow is king. Even a profitable business can fail if it cannot manage cash going out and cash coming in. Effective payment systems help you to maintain strong relationships with subcontractors and suppliers, avoid disputes, work stoppages and reputational damage, take advantage of early payment discounts where offered, stay compliant with contract terms, security of payment laws and tax obligations. Poor payment practices can lead to subcontractors refusing to return to site, suppliers placing the business on stop credit, interest, legal costs and damaged reputation with clients and banks. So, pay contractors and suppliers is not just an admin task, it is a strategic financial control. Review of invoices. Before paying any invoice, it must be checked carefully. Invoices should be reviewed for correct entity details, business name, ABN and address, matching contract or purchase order, rates, quantities and scope of work, date and invoice number for record keeping and tracking, GST treatment, correct calculation and clear GST breakdown, evidence that the work or goods have been delivered as claimed. For subcontractors, you should also check progress claimed is consistent with site records and supervisor reports. Any variation claims are supported by written instructions or agreed rates. Once all of this has been verified, the invoice can move to the next stage. Authorization for payment. Securing authorizations for payments. A good construction business does not allow invoices to be paid without clear approval. Standard authorization controls might include dollar limits for different roles, for example, supervisor, project manager, and director. A two-step process, checking the invoice for accuracy, then approving it for payment, using purchase orders so the invoice can be matched to an existing commitment. Authorization should always be documented, signed, initialed or approved in an accounting or project system. Traceable. It should be clear who approved each payment and when. These controls reduce the risk of incorrect, duplicate or fraudulent payments. Paying suppliers and contractors. Once authorised, the invoice moves into the payment run. In most Australian construction businesses, this is done via electronic funds transfer through internet banking, occasionally BPJY, credit card or cheque, depending on the supplier. Key payment considerations: follow the payment terms in the contract or supply agreement. Align payment schedules with your own cash flow and client progress payments. Group payments into a regular payment cycle. such as weekly or fortnightly, so that cash flow can be forecast. You should avoid ad hoc payments with no schedule, paying one creditor early and leaving others unpaid without a plan. Consistent, predictable payment practices help everyone on the project. Securing proof of payment. Every payment made by the business should be supported with proof. This is vital for resolving disputes about whether payment has been received, preparing financial statements and tax returns, satisfying auditors, banks, and the Australian Taxation Office. If records are reviewed, proof of payment may include bank transaction confirmations or statements, payment remittance advices, emailed to suppliers and subcontractors, system records from your accounting software showing paid status and date. These documents should be stored and cross-referenced with the original invoice so you can easily demonstrate what was paid, when it was paid, and which invoice and purchase order it relates to. Managing revenue and progress payments. On the income side, construction businesses often rely on progress payments from clients. These payments must be invoiced correctly and tracked carefully. Key tasks include issuing progress claims or invoices in line with contract milestones or reference dates, ensuring claims accurately reflect work completed on site, recording when each claim is approved, partially approved, or disputed, monitoring when progress payments become due and payable. Good management of progress payments helps you to predict incoming cash and plan outgoing payments, identify slow-paying clients or problem projects, reduce the need for short-term finance or overdrafts. The next step is to understand how to invoice and how to demand payment correctly. Invoicing and types of invoices. In construction, you will see a range of invoice types, including standard invoices for one-off goods or services, progress claim invoices based on percentage, complete, or stages of work, deposit or advance invoices at the start of a project or milestone, final invoices at completion, including retention release where applicable. In many jurisdictions, a payment claim under security of payment legislation can also be made using an invoice as long as it meets the required criteria, such as being in writing, identifying the work and stating the amount claimed. Understanding these types helps you invoice correctly and strategically. Invoices and payment claims in practice. Under security of payment legislation, a properly worded invoice may also function as a payment claim. To do this, the invoice should contain all the usual tax invoice information required for business records, describe the construction work or related goods and services supplied, show the amount claimed, including GST, clearly state that it is a payment claim under the relevant Security of Payment Act, where required, using invoices that double as payment claims can. Strengthen your rights if payment is delayed. Allow access to rapid adjudication processes where disputes arise. However, it is important to follow the exact procedural and timing rules in the relevant legislation. Demanding payment and tracking progress. Demanding payment does not mean being aggressive. It means being clear, timely, and consistent. Good practice includes issuing invoices or payment claims on schedule, not weeks late. Sending polite reminders before and after due dates. Keeping a record of all communications about payment, including emails and phone notes. To manage progress payments effectively, you need a tracker that records invoice or claim number, date issued and due date, amount claimed, amount certified, and amount paid, date paid, and any outstanding balance. You can build this tracker in accounting software, a spreadsheet, or a project management platform. The goal is to always know who owes you what and when. Recovering outstanding debts. Even with good systems, some clients will delay or avoid payment. Having a clear process for recovering outstanding debts is essential. Typical steps include a friendly reminder once the due date has passed, a formal reminder or statement of account, a letter of demand citing contract terms and payment obligations, considering adjudication, mediation, or legal action for serious disputes. You should also review whether to continue work if significant amounts are unpaid. Assess whether credit terms need to be tightened for that client in future. Factor bad debt risk into pricing and project selection. Well-structured debt recovery protects cash flow and profitability. Payment methods. Payment methods should be simple, secure, and traceable. For paying contractors and suppliers, common methods are electronic funds, transfer to nominated bank accounts, BPA or credit card for some suppliers. Checks in limited situations, though they are less common now. For receiving payments from clients, you might offer electronic funds, transfer with clear remittance advice, online payment options through accounting or invoicing platforms. For smaller works, card payments or common payment services. Whatever the method, make sure payments are easy to match to invoices. All transactions are recorded in your accounting system, and security controls are in place to prevent fraud and errors. Monitoring financial health. Paying contractors and suppliers on time is only sustainable if the business itself is healthy. Monitoring financial health means regularly reviewing sales and revenue. Is income stable, growing, or falling? Gross profit and net profit. Are projects delivering the margins you expected? Cash flow. Do you have enough cash to cover wages, materials, and overheads? Debtor and creditor balances. How much is owed to you, and how much do you owe? Rather than waiting for year-end accounts, you should review financial reports monthly, at minimum. Use ratios and simple analytics to spot trends early. Act quickly if signs of stress appear, such as falling profit, increasing overdraft usage, or growing overdue debts. Sales calculations and case study. Sales calculations help you understand how much income is being generated and whether it is sufficient to cover costs and profit targets. Basic measures include total sales for the period, such as month, quarter, or year. Sales by project, client, or sector. Average sale or average project size. In a simple case study, you might compare sales for this year versus last year. Sales against your budget. Sales concentration, for example, whether a small number of clients make up most of your revenue. From this, you can ask whether you are relying too heavily on a few clients, whether you need to diversify your project mix, and whether you are on track to cover overheads and achieve the desired profit. Financial ratios. Overview. Financial ratios convert raw numbers into interpretable indicators. In this module, we focus on three groups: profit ratios, how profitable the business is; liquidity ratios, the ability to meet short-term obligations; financing ratios, how the business is funded, debt versus equity. Ratio analysis allows you to compare performance across different periods, benchmark against industry norms, identify early warning signs of financial stress. The key is not to memorize formulas for their own sake, but to understand what the ratios are telling you about operations, pricing, overheads, and debt levels. Profit, liquidity, and financing ratios. Let's briefly look at the three ratio types. Profit ratio examples: gross profit margin, gross profit divided by sales; net profit margin, net profit divided by sales. Liquidity ratio examples: current ratio, current assets divided by current liabilities; quick ratio, a stricter measure that excludes inventory. Financing ratio examples: debt to equity ratio, total liabilities divided by equity; interest cover, earnings before interest divided by interest expense. By reviewing these ratios regularly, you can see whether projects are priced correctly, whether the business can comfortably pay its bills, and whether debt levels are sustainable or too high. Improving financial position and recommendations. Once you understand the numbers, the next step is to recommend actions to strengthen the business. Options might include improving pricing and quoting to protect margins, tightening cost control on materials, labor, and overheads, accelerating debt collection and reducing overdue receivables, renegotiating supplier terms or financing arrangements, reducing non-essential expenditure. A recommendation report should summarize the current situation, including key figures and ratios, identify the main issues or risks, Propose specific actions with responsibilities and timeframes. Indicate expected benefits, such as improved cash flow, stronger profit, or lower risk. This report can then be presented to owners, directors, or senior managers for decision. Maintaining and saving financial records. None of this analysis is possible without reliable records. In Australia, businesses are generally required to keep most financial records for at least 5 years. Good record keeping means keeping all invoices, receipts, bank statements, contracts, and payroll records. Ensuring records are accurate, complete, and timely. Storing them securely, either in paper form or digitally, and backing up digital records. Simple record-keeping rules are to record all transactions, keep original documents or clear digital copies. Organize records so they are easy to retrieve. Protect records from loss, damage, or unauthorized access. Retain records for at least the required legal period, or longer if needed for disputes or long-term projects. Accurate records protect you during tax reviews, audits, client disputes, and legal proceedings. Linking payments, ratios, and records. Paying contractors and suppliers is tightly connected to invoicing and progress claims, cash flow and debt recovery, financial ratios and business health, record keeping and compliance. When these systems work together, contractors and suppliers are paid on time and correctly, revenue is invoiced and collected efficiently, management has clear visibility of profitability and risk. The business can grow confidently, backed by solid financial foundations. When they do not, even a busy construction business can quickly run into serious financial trouble. To summarize Module 3, Volume 1, Section 3, Pay contractors and suppliers, we covered how to, review invoices from contractors and suppliers, and secure proper authorization. Pay contractors and suppliers in a controlled, traceable way and keep proof of payment. Manage progress payments from clients, use invoices and payment claims, and track claims through a simple progress payment register. Recover outstanding debts using clear processes and, where necessary, formal recovery options. We then link this to the financial health of the business by looking at sales calculations and a simple case study. Financial ratios, profit, liquidity, and financing, and what they tell us. Practical options to improve the financial position presented in a recommendation report. Finally, we emphasize the importance of accurate financial records for taxation, compliance, and decision-making, and the need to keep records for an appropriate period in line with Australian requirements. Thank you for joining me in this session. I'm Sudha Udaya, and I look forward to working with you in the next part of the course. Don't forget, our LMS contains interactive learning video series. Please watch them as part of your study and link them to today's session. To support your study, we've introduced the AI Playbook. This tool simulates assessment questions and provides guidance. You can access it from your assessments. Thank you for joining me today. I'm Sudha Udaya, and I look forward to seeing you in the next lesson.